And my next guest says there's more pain to come, but that will bring us back to stock picking fundamentals. So what names should you stay away from, and where are the best opportunities? Joining me now is Gina Sanchez, Lido Advisors Chief Market Strategist. And this is 3 bails and a buy, Gina, because with rising rates, they are vicious. Welcome. And let's start with the TLT. This is not really a stock, but it's an important one to highlight because some people are bottom fishing right now. It's down 16% since July. As I've heard, it's lost half its value from the highs, but you still wouldn't be a buyer here of this long Treasury bond, would you?
No, we wouldn't. We are looking at, the yield curve has been inverted for so long, predicting the recession that just won't come. And even though we're probably going to get maybe a little bit of a slowdown, at the end of the day, the short end is not coming down, which means in order to get a normally shaped yield curve, the long end has to come up, and it's not done yet. It still has to continue to price in at least some semblance of growth and probably permanently slightly higher inflation than we're used to. Deglobalization is driving up inflation and other factors that are sort of going to keep inflation a little higher than we've gotten used to. So that long end's got a lot more pain to go.
All right, so that's kind of the perfect backdrop to segue into some of your stocks, which could be under pressure as a result, namely Ford. A lot of people talking about this because of the union strikes, but it's down more than 20% since the summer, facing a slew of headwinds that include that, but also its high debt load.
Yeah, the problem with Ford is they had to take on quite a bit of debt during the pandemic, and a third of that debt is coming due in the next 12 months. That's a big hunk of debt to have to refinance at significantly different rates. And so profitability is already under pressure. They're having a lot of issues with getting their, EV game on. The strikes do not help. And so you have a lot of issues just pushing the business, and take on top of that higher yields for a third of its debt load. That's a big challenge. I think it's a good example of companies whose debt are about to come due. Be careful of those.
Yes, and this has been, obviously, high debt has been plaguing the company for a very long time, and it's like the worst possible time for it all to be coming to a head. Speaking of which, Petco, that's your next stock, also getting a lot of attention and balance sheet scrutiny. It's down nearly 60% over the past 3 months because of this pressure, and it hit all-time lows yesterday. So you think it can, it's under a $4 stock at this point.
Yeah, the problem with Petco is that they have the problem that they have floating rate debt. So it's not like a bunch of fixed rate debt is coming due that used to be cheap. It's that they've just been going up with the markets and their profitability is under pressure. We're seeing them guide down on profitability, and I think that that's going to remain under pressure, regardless of how resilient you think the dog and cat food market is. This company is going to have, continuing troubles providing profitability. And in a higher interest rate environment, you don't get great multiples. So you have to perform. You have to be profitable. This is going to be a challenge.
Yeah, this feels like a market where narratives die. It doesn't matter if you're in the pet food category. All that matters is the balance sheet with rates doing what they are. So those are your bails. And now the one that you would be buying is Costco. It's up 24% this year. We all know kind of a stalwart business, but you think especially in a tough rate environment?
Yeah, this is a company that has a whistle-clean balance sheet. This is a company that probably has more cash than debt right now. And that is huge. Cash is king when interest rates are going up. And on top of that, this is also a company that is very defensive. It's the kind of company you want to own in a slowdown when people are feeling tight. If you look, just today or yesterday, we saw a stat that came out of the Fed showing that the sort of lowest socioeconomic sectors of the economy are more or less out of savings, which is to say that they're going to have a hard time paying basic, costs. Costco is where you go when you're trying to save money.
PE 37 nearly. Incredible. But again, they're being rewarded for having kind of the right choices now. Gina, thank you so much for your time today. We appreciate it.